When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the marketplace. Shawn, how you doing this morning?
I'm doing good. Never better.
Never better. That's good, man. That's a pretty lofty statement to make there this early on a Tuesday morning. Well, Shawn is comes on. We talk about what's happening here, and Shawn, there's plenty of stuff to talk about. And this interest situation that we see. I don't want to say that the interest situation is destroying the world, because it's not. I think we're just having a hard time getting used to the new normal. So I guess as you look at what's going on in the treasury markets, and you look at where the strength of the dollar is at and how that stacks up against the rest of the world, and how it prices our commodities when it comes to exporting grain and whatnot. What are you seeing? How do you think the market's reacting to that? And then we got this report coming up here not too long ago because the government found some more money. So
right now it seems like you're a fighter that's been punched in the chin. You just got off the tarmac, and you don't know where you're at, because that's what's happened with interest rates. We haven't seen something like this for at least 15 years. There's two sides of this, right? There's the side of the cost of capital going up for people that are indebted, either personally or corporation wise. The rolling cost, all the things we talked about last time, which is the banks, which, that's the negative side. But remember, there's the other side. There's the people who have a lot of cash, who now can generate lots of income on their cash at a very low risk. And so can corporations. So NVIDIA, that's or Google, that's sitting with $100 billion in cash. They're making a ton of money on interest on that cash. So there's a lot of income coming in from the cash side of the ledger. So it's nothing is ever a one-sided story.
sure.
The narrative is, it's the worst thing that's ever happened, but the worst thing ever happened is that we had 0% interest rates. That's never was something that ever should have happened. So I think the way I think what the Federal Reserve did in the last communique, there's a limit to how much short-term rates can impact the economy, right? Most everybody lives in the 10 to 15-year horizon with their loans, whether there's a corporation, whether it's a person. We don't live we're not borrowing money on a 1 to 3 month basis. We're borrowing money on a 10-year, 20-year, 30-year basis. The problem has been that we've had this massive inversion in the yield curve, where the Federal Reserve kept moving rates higher, but the long end, the 10-year and the 30-year, were not moving higher. So they got themselves to a point where we've put the maximum pressure we can on the short-term interest rate situation. But if we don't get those longer-term interest rates up, we're sort of becoming inert in our ability to impact inflation and the economy the way that we want. So they theorized, and they had made a great call, by the way. They theorized that they came out and said the economy looks strong. We don't see a recession, and it's higher for longer. That would shake up the 10-year and the 30-year interest rates to go substantially higher, because if a recession is not coming and they're not going to lower rates anytime soon, then the long-term rates are mispriced. and lo and behold, the day they came out with that communique, that afternoon, set off the sell-off that's still going as we speak. We're approaching 5% on the 10-year and 30-year interest rates. Just a dramatic increase from the last Fed meeting. So they're getting exactly what they want, which is higher, longer-term interest rates to do the dirty work that they no longer can do to get the economy to remain throttled down. Now, what is this also doing? The inverted yield curve flattening. So we were like this, and now we're going like this. Well, banks are going to lose less money now because this way they pay out a lot and they can't lend out. So they lose money all day long. Now we're getting this. We're getting almost a flat market. Now, that's not great for the banks, but at least they don't lose much money anymore. At least they can run fairly close to break even with a flat market, meaning what they pay out is the same as what they're getting in from new loans that they're issuing. And that's better for the banks. Now, obviously, what the banks want is this, where that long-term rates are higher than the short-term, and then they can make money again. But I think they realize that we can't have the banking sector in this environment forever, or else the whole banking sector is going to have to be bailed out. So I think they're getting what they want, which is a higher long-term rate and a flattening of the curve. And so I think that we're going to this interest rates backing up. I think we're going to stop around a flat curve. Meaning I don't think the 10-year and the 30-year are going to go dramatically above the Fed funds rate. I think that's where we're going to be for a while. And then the Federal Reserve next move will be, when do we start steepening the curve? So when do we feel that this is doing enough to where we can start lowering the short-term rate and steepening the curve, which then starts the whole banking cycle, the whole credit cycle going again. Mm-hmm. I think that's where we're at. And it's not necessarily that all of this is like bad. It's just that the markets are moving so fast that it's very hard for the market to adjust in that short time span. And so I said, I think the market is sort of just stunned right now about what to do and confused. And we just need some time for these markets to start stabilizing, to have the market kind of reposition itself and get ready for the next act. And I believe the next act is, they say higher for longer, but we know that the Federal Reserve forecast are probably the worst out there on the planet. Every time they say something, they get it wrong. So the fact they're saying longer for later probably means they're going to be cutting rates in the next 3 months. I mean, it's just whatever they say, just think something completely different, and that's what's ultimately going to happen. But the next move is going to be them doing this, and that sets off a completely different cycle for risk assets, commodity assets, the dollar, all these sort of things. We're just not quite there yet. And so at the moment, we have money rushing into the U.S. dollar soaring in value, and that always is a depressant for commodities to go higher as we price ourselves out in terms of our prices relative to foreign prices, in terms of trying to sell stuff. And at the same time, it just makes the translational price in U.S. dollars in corn or wheat or coffee, it just makes it harder for the market to move higher. There's no example of a runaway advance in commodities while the dollar is in a strong uptrend outside of brief spikes higher due to either weather or geopolitics. So that's kind of where we're at. These trends are well underway, which means they're not just beginning, they're nearing the end. And so we're just going to look for signs for reversals here, Casey. We want to see that day where the interest rate starts up and then turns down. It's suggesting an exhaustion top, or the dollar moves up and then reverses down. We think October we're going to see that happen. We're going to see some big reversals that suggest that whatever has been going on with the capital flows, we've reached a crescendo that will then normalize and change this panic situation that we seem to be in right now.
Okay. All right. So as you look at this upcoming report that's coming out here in next week, I think the 12th, if I remember right, what are your thoughts there, and what do you think the market's going to show?
Well, at least we're going to have a report, I guess. I mean, some people would argue they wish we never had a USD report, but I still think having somebody say something is better than somebody saying nothing. We've been through periods where the USD doesn't put out reports, and the markets don't like that. So at least for the next 45 days, we're going to get some more USDA information. What happens after that, I have no idea. We'll have to see if what happens. But anyway, as always, there's the camp that says yields are going to come down dramatically. There are those that say it's going to go up. Right? I mean, that's the market. There's always two sides of every trade. I don't believe we're going to see big knockdowns in yields. I don't believe that the evidence supports that. I think the best case scenario right now is that the USDA's incrementally do things. I think a modest reduction in yields is probably the likely outcome here. I don't think either one of those, if that's correct, I don't think any of that actually changes the market's view of where markets are at. I mean, I don't think going from 173 to 172 or 171.5, I don't think that matters a whole lot to the corn market. And I don't think soybeans going from 50 and change to 49 and change, I don't really think those, outside of maybe a short-term 1 hour trade from algorithms, is going to matter much. I think more importantly, I think the market has settled in, that we have crop yields below trend. The numbers are what they are. We can argue what they are, but that we're just sort of in a holding pattern, wondering when is the harvest pressure season going to end, and when are we going to begin the post-harvest rally season, when we start to lock up the corn in the bin, and when we start really looking at the outlook for South American weather, especially weather in Brazil. And, are we going to have bumper crops again, or might we have a different outcome? As you know, Casey, our work strongly suggests that we are going to have a lot of worry and potentially, crops come up short of the last couple of years. And I think, it's too early for that trade to happen yet. We need to get more into late November, December. But that's actually not that far away. In the market, if you look at the weather patterns thus far, it's a dry weather pattern. We have a dry weather pattern overall for Brazil. And I think that's a precursor or a warning shot that that's the pattern. And one thing that we highlighted in our report this week is, that the El Nino is really, really weakening. It's not strong. It's not coming forward in the atmosphere like one would have expected, or that many would have expected. And that means that the El Nino Mordecai condition is advancing. And an El Nino Mordecai condition advancing is a much, much more caustic weather pattern for the northern half of Brazil. And if you draw that box, center Brazil all the way out to Mato Grosso, up and back and around, and you say how much of soybean and corn production comes from that box, and we're going to keep the southern Brazil out because they're getting plenty of rain, okay? You're talking about 60% of soybean production and about 75% of corn production comes from that box that I believe is going to be in the crosshairs of significant drought worries as we move into the December, January, February, March, April timeframe. And in the least, that should suggest weather premium needs to put in. And obviously, if we actually have a crop problem that lowers production, then obviously it puts the market more on edge for the U.S. to finally deliver on a big crop for 2024. And it does not look like that there's much hope that that's going to happen according to our work. It looks to us like we're having La Nina coming back for the summer of 24. And that is not likely going to produce the kind of weather that we would need to have trend line or above trend line yields. And then the question becomes, do we finally get the right combination to create the major crop problem? We've danced around that for the last 3 years. We've danced around it. We've had certain areas that have had, drought that's been, but we haven't had the major crop problem. We've had below trend line yields. The Gleisberg cycle that we've been talking about for a while is highly, is set to deliver if it repeats again after 11 centuries of repeating. 24, 25 are the two most highly probable years for that. And so we're going to be on the lookout to see which one of these years has the right combination to provide potentially that kind of outcome. And obviously, if Brazil gets into trouble and the U.S. gets into trouble, crop prices would have to then adjust accordingly.
Awesome. Good news. Good news. All right. All right. So looking at that was my next question. I was going to ask you about your client model, but you kind of already went through that, what that looks like. And the report.
Well, we showed on this week's report a chart of the El Nino Mordecai Index, which is the difference between central sea surface temperatures of the Pacific and the East. And we showed that chart for the beginning of 2023 to now. And there's been a big surge, meaning what you want to see is the center warming at a faster rate than the East, which means you want to see that line rising. It needs to rise to a plus 0.5 degrees Celsius, meaning that the Central Pacific needs to be 0.5 degrees Celsius warmer than the East Pacific. We were at like a minus 1.5, very Eastern based, and now we're at minus 0.65. So we've had a big surge off of that low. And looking at the trajectory, I just looked at the last couple of days, we're still moving rapidly in that direction. Our view is that, by the time we get to December, we're going to see a plus 0.5 degree C premium to Central Pacific sea surface temperatures versus the East, and carry on in El Nino Mordecai through at least, March, April. And so everything that, right now, that is what we wanted to see. It was a signpost that we've been putting out there that we needed to see that index start to wake up and show a movement in that direction. And it is moving in a dramatic fashion, supporting our overall view that is increasingly likely that outlook, which is highly contrarian, by the way, looks to be on track to occur. And if that's true, then Brazil is on the docket for some major weather problems this growing season.
That will dramatically change the way things look, especially where we're at with ending stocks, the way they look, and the overall just supply that we have as you look at demand. Now, all that being said, as you look at supply and demand right now, do you feel like supply and demand have kind of caught up with each other, and that we are at a point where things are really in a good spot, even though they're lower than what they normally are? But as far as kind of what we've talked about so far with what we've seen happen in the marketplace, do you feel like the supply and demand curves have kind of come together and have formed a good relationship again?
Typically at this part of the cycle at harvest time, we typically make our seasonal lows. Typically, not every time, but typically.
Right.
The supply side gets pretty crystal, right? We're getting much more clear about quantity that we're going to have. When you've been in a negative bear market in commodities, especially in grains, for well over a year now, the bias tends to be that people get more negative about demand because the high prices that we had for 2 years hurt demand.
Right.
And you don't snap your finger, and just because you lower prices, demand doesn't just wake up one day and say, oh yeah, we're going to go, you got to rebuild the demand. So the bias at this time of the cycle, when we've had a 15-month decline in grain markets, is that the market is too low. They're too negative on the demand side of the equation. They're projecting out much lower demand for next year based upon the high prices that we had the last couple of years, which is really not a logical thing to do, because the low prices we have today is going to improve demand over the next 12 months. So I think the supply side, we are normalizing. I think the demand side is the next shoe to drop in terms of having the market increase their optimism over the kind of demand we're going to see for soybeans and corn, especially as we get to the latter part of 23 into 24. So I don't think we're calibrated yet on demand, but I certainly believe we're calibrated on supply. So the opportunity here is, as the market has probably priced in the worst demand side picture they're going to price in for the next 12 months, in my opinion, our opinion, there's only one way to go but up from here on demand side expectations, meaning you only can improve that. Well, if you improve the demand and the supply is what the supply is, then your balance sheet ending stocks begin to shrink. And then what you thought was adequate supplies become less adequate. And especially if we're going to worry about a Brazil crop problem, which they are, they are a major player here.
Yeah.
Than having just adequate, a lower, we don't have a balance sheet. Like, I guess the point I'm trying to make is we don't have a balance sheet that can absorb a major crop problem for Brazil. Now, if we had 3 billion bushels of corn and we had 600 million bushels of soybeans and ending stocks, we probably could. But when you have 200 and whatever the government said, 65 million bushel carry out for soybeans, which I believe is too high, and they say we have 2.2 or 2.1 million bushels of corn, which I believe is too high. I think ultimately what we're going to wind up having is 200 million bushels carry out for soybeans and probably closer to 1.7 billion on corn when we correctly manage the actual demand versus the actual supply. That is not enough to handle a major crop problem in Brazil. And that's the point is, that when the market starts to worry about Brazil, if we're correct about that, our balance sheets will very, very quickly, move into the danger territory. And that's where the 2024 December corn, 2024, November soybeans, 2023, that's where those balance sheets could really have to change a lot from the current pricing out on the curve there. And so that's why we've been suggesting that those in the livestock industry, whether you're a cattle hog or dairy, looking at December 24 corn and November 24 soybeans and meal and all that sort of thing. I think we're at a spot where I would be wanting to make sure, I protected my upside price risks on feed, given where I think we're at. I think that is something, everything on the farm is risk management. We never know for sure what's going to happen. No one can say, I know for sure this is going to happen. We can only speculate. But we always have to weigh where we think the probabilities lie. And I think from where we're coming from with weather and geopolitics and monetary policy, election year, I think that this is a time to make sure you don't get caught with a dramatically higher feed price sometime later on in 24, when right now we have some of the most attractive meal prices and the most attractive corn prices in those deferred months that we've seen in several years.
Right on. Okay. A lot of stuff, a lot of moving parts right now, Shawn. A lot of moving parts. More moving parts now than I think when I first started doing this podcast. So it seems like there's just like everything has got some kind of hinge to it somewhere, and none of it really doesn't matter about one other piece that you need to have to complete the puzzle. That doesn't seem to matter anymore. You just kind of have these things that just are happening.
It's complicated. I mean, and nobody has all the answers. I don't have all the answers. We try to synthesize all this the best that we can. But what I do know, and I try to break this down in the simplest way that I can. What I can say, if Brazil has major crop problem worries, that is under most circumstances that I can conceive of, that is going to have an impact to grain prices. We can argue about the dollar, we can argue about interest rates, we can argue about geopolitics, we can argue about all kinds of things, but I'm pretty confident that if one of the largest producers of soybeans and corn and exporters of both in the world has serious crop worries in this growing season, we're going to see grain prices have to respond and put on weather premium if we're correct about that. And so it always, to me, always comes back to the weather forecast. We always lead with the weather forecast. Weather overrides all things if it's meaningful enough, no matter what. And so, we spend most of our time trying to hone in on the weather, trying to hone in on our cycles that we follow to try to provide the best long-term probabilities of what we think is going to happen well before it happens, so that you can take corrective action well in advance. And doesn't mean we're right every time about everything we say. Nobody can be, but our track record hasn't been too bad on predicting these weather patterns and what happens over that 6 to 12 month time. We've been pretty good at it, and I think we're going to continue to be pretty good at it. And right now, with all that being said, with where we are today, so long as that I'm remotely right about a weather problem developing in Brazil, I think what I've just said about livestock producers needing to manage their feed risks is the right, it's the right strategy for operators looking at their feed costs going forward.
Yeah, those feed costs are something that kind of a crazy situation right now as you look at what's going on there and what the horizon looks like when you start taking a peek of that. So speaking of that, and we'll wrap up with this. The cattle market took a beating last week, and kind of the first real beating they've taken in a while. Looking at how that's been just on a straight up trajectory. Is that a end of month, end of quarter type of situation, Shawn, or do you see some correction there that's coming that's more long term?
Look, we've been too negative on this market a little too early, like many. So we're going to put that out there. This market's gone up further and for longer than we had thought, but we've been warning about the fourth quarter for a long time. The cattle on feed that needs to come through the system in the fourth quarter is actually quite large and larger than last year. And when we looked at the price pattern going back 50 years and how overextended the market was, and you throw in all this panic over interest rates and the dollar and the Brazilian cattle price falling and the Australian price, it just seemed to me like no market goes up forever. I know cattle markets is going to go up forever, right? It's going to go up forever. It's never going to stop.
Never going to stop
forever. We're going to 1,000. We're going to 1,000. $10 a pound. That's where we're going. I know it's never going to stop, but it actually is going to stop, and it's going to stop when you don't expect it to stop, and it's going to fall when you didn't anticipate to stop. And my job is to make sure that those that are paying attention to me, that want to pay attention to me, they don't have to pay attention to me, but if they want to pay attention to me, to provide them with recommendations to keep more money home on the farm. And when you have the money that's on the table in the cattle business right now, after years of horrendous operating conditions, you don't have to, I believe you have to protect that. Period. End of story. Anyone that is not protecting that is just falling prey to the bullish bias that befuddles every bull market in history, that everyone thinks it's never going to end. They're always going to be able to sell before it falls. And of course, that's just folly. That never happens. You never sell before it falls. You only sell after it falls. And when the market's down 20 or 30 cents off the top, and you've given your margin away, now you have to sell, and you miss keeping money home on the farm. My view is, you have to protect your margin. You have to protect these cattle prices into next spring, and I'm sticking by that. And no, it doesn't mean that the supply side of the equation is looking terribly bearish next year. It actually looks constructive. It doesn't mean that we won't have some type of rally in the back half of 24 to provide another window of opportunity to sell. The point is, everybody has to sell all throughout the year, and you want to make sure you're not selling your cattle from now through April at a level that's dramatically lower than it was when you had the opportunity to lock in a very healthy margin on the farm. I just think that is, to me, there's not every year you wake up as a producer in any part of the business, whether it's corn or soybeans or hogs, and say, I can lock in a margin. But when you have the opportunity to lock in a margin, and a very good margin at that, thank the almighty Lord upstairs for providing that opportunity, and please take it. That's our view.
It's pretty good advice, Shawn. I'm not going to lie to you. It's always easy to look the gift horse in the mouth there a little bit on some of the stuff, and you're always going to get that extra nickel somewhere, right, Shawn?
Yeah, so, it's always the corn farmer says, I had my sell in at 751, it got to 750, and I didn't get filled.
Yeah. Yeah. Yeah.
I don't know what else to say.
I know what you mean.
But I can't tell you how many times that actually happens. 2 cents away and I didn't get filled. Now the market's down 50 cents. What do I do now? Just get it done.
Yep. For sure. All right, Shawn, good stuff as usual. Folks want to reach out to you and get more information about what it is you're doing over at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. We also have a Twitter page at Faradix11. And we're not habitual posters. From time to time, we'll throw in some interviews and some ideas of things to let people know what we're thinking and doing and how we look at the world, to see if our statistical, cyclical, correlated approach to looking at ag markets is of value to your listeners.
Right on. Well, Shawn, I appreciate you being on the podcast, and we'll talk again on Thursday.
Sounds good, Casey. Talk to you soon.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the ever so cleverly named YouTube channel. Just hold on, folks. The Moving Iron Podcast YouTube channel. I know this blew your mind about how creative that was. So check that out over there if you want to see the video version of this. Go to movingironllc.com for everything Moving Iron related. You're going to have some big announcements here in a couple of months, over the next couple of months, that are going to lead into some things about Moving Iron Summit and other things like that. So check that out. I can give you the dates for the Moving Iron Summit. It'll be November 4th through the 6th in Nashville, Tennessee, and we'll have a nice little thing going on down there. Going to get a few things organized and shaped up, and also I have more information about that here shortly. But there'll be a few other announcements that'll be coming out as well. So pay attention to that. So with that, I'm Casey Seymour with Shawn Hackett. Let's move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving